Welcome back to another explanation video where I will be explaining liquidity, the different forms of liquidity and how to use liquidity in your trading. So I'm Oscar Madsen, I'm a funded trader as well as a trading coach inside the Trading Academy, and in this series I'm trying to give you guys my strategy on technicals. So let's get into the chart, let's look at different forms of liquidity, let's write them down and then let's see how we can use them. So we're at the chart here, but let's first explain what liquidity really is. So liquidity are points in a market where there are stop losses located and where price could react from. So under these lows, there is liquidity. And what do we expect? Well, if we take out the lows, we expect a reaction because we take out their stop losses, which pushes price back up higher again. So under lows there is liquidity, and also above highs there is also liquidity. Okay, so those are points where stop losses are headed. You gotta see it like something like this. When there is a high, a lot of people, they went selling, they put their stop loss above and they sold to the downside. So if we now trade up higher, we take that high out, we take stop losses, which equals to liquidity, and that from that liquidity we could get a reaction down lower again. So we have three different forms of liquidity. First of all, we have trendline liquidity, major liquidity, and we also have internal liquidity. So let's dive in the markets and let's see what they look like. So let's talk about our first form of liquidity, which is trendline liquidity. So first of all, liquidity is located above every single high or low. So under this low, under this low, under this low, under this low, above this high, above this high, above this high, above this high, above these highs. Okay, so trendline liquidity are multiple of those highs stacked close to each other. So these three highs over here are stacked close to each other. You can see we have our first one, then a little bit higher we have the second one, and then even more higher we have the third one. So it's not always 3, it can be 4, 5, 6. It's just multiple highs stacked close to each other, and this forms trend line of liquidity. Now what is it with trend line liquidity? Well, we expect for the whole trend to get taken out and then only react from it. So we're not specifically expecting a reaction from this liquidity, not from this liquidity, but from this liquidity high, because that's the end of the trend liquidity and we only expect a reaction after we took out all of the trend line liquidity. So basically these highs are all pretty weak and we just expect to that get taken out in one move. Okay, and from there we could then react. So that's trendline liquidity. Let's now talk about major liquidity. So major liquidity is basically a point which is a major low, for example, like this swing low, right? Because we can see we are swing bullish, and then this swing low is a major low, so a really big low, as you can see in this example. And this is also a major low. So again, we have liquidity at all these points, but this is our major low and this is also major liquidity. So yes, from these liquidity points we could expect a reaction. That's true also from these liquidity points, but the hardest reaction is expected from major liquidity. Okay, so from this point, from this point. Okay, and it could also be at the highs, of course. So as you can see, we trade up higher, lower, higher, lower. So we have all of these liquidity points over here. But what is our major liquidity point? Well, our major is of course this high and this high. Okay, because we got a major pullback from that point. Okay, so once you take out major liquidity, you could definitely expect a big reaction from that liquidity. Of course, always wait for confirmation before entering off of liquidity, but those are points where we could expect a really big move. So that's major liquidity. And now, like I explained, we also had these types of liquidity points, and these are internal liquidity points. So what are internal liquidity points on the chart? Well, if this is our major low, then inside we have little bumps in the roads, right? So these are internal liquidity points, and from these points you could get a reaction, but it's not expected to get a big move up higher, for example, just only from that liquidity. Of course, in this case we are swing bullish, so if we take this internal liquidity, we could then again trade up higher, but it's not that only this liquidity pushed the price up higher. Okay, this is just internal liquidity. It is not as strong as major liquidity, but it's still liquidity what you can look out for in order for a small reaction to trade up higher. So with that being said, we explained everything about liquidity. Let's now talk about how we can use it. So how to actually use liquidity inside our trading strategy? Well, first of all, liquidity is one of our points of our checklist. Super important. Our checklist is market structure, premium versus discount, supply and demand, order flow, and liquidity. So whenever we have liquidity, we can take the setup. If you want to take a long setup and we do not have liquidity, you can make sure that you will become the liquidity. Because remember guys, what is liquidity? Liquidity are stop losses. Well, if we take a long setup and we didn't yet take liquidity, aka stop losses, well, you know damn sure that we are going to get taken out and our stop losses are going to be used as liquidity. That's our first thing that we need to take a look at, our checklist. And of course, liquidity is also used in our entry model to take our entry. So let's now dive in the charts and let's see what this looks like. Let's talk about liquidity on our checklist. So first of all, let's see what we are. Well, we are for our bullish, we have demand to push price up higher, and we also have our premium versus discount tool that shows us that from this discount prices we could trade down lower. So what a lot of you guys would do is look for our entry confirmation inside this demand, and you guys would go long, or some of you guys would go long and trade something like this. But then what you can see, if price just hits our stop loss in one big move. Now why does this happen? Because we didn't check out liquidity, and then of course we become liquidity ourselves. So in this move up, you can see that there was no liquidity. Remember guys, liquidity is a point or a low. Well, in this move up, there is no liquidity at all. Where is liquidity located? Well, at these little liquidity points. So we first want to wait for these liquidity points to get taken out, and then we look at our entry confirmation to go long. So again guys, if we didn't yet took any liquidity, for example over here, we expect to take liquidity, for example under the demand zone or just anywhere at all on the chart before moving up higher, otherwise the trade is not valid. So let's now take a look at liquidity in our entry model. I found a perfect example of a long setup here, so let's talk about liquidity in our entry model. So let me first explain this trade. We are 4 hour bullish. After the move up, we got a pullback and we already traded inside discount prices. We see that we tapped in towards demand and we took internal liquidity. We can then see that we have bullish order flow, and then once we tap in towards this demand, plus we take another form of liquidity, which is again internal liquidity, we then see our entry confirmation, which is a fractal break to the downside and then to the upside. If you don't know how this works, make sure to watch my video on it. But this is our confirmation. So once we took liquidity, we broke the fractal low, and then after that liquidity grab, we traded up higher and broke the fractal high. This was our confirmation to go long. And then what a lot of you guys would do, which is completely normal, is place your entry on top of the demand with your stop loss underneath the demand and trade up higher. Now what is the risk with this trade, for example? Of course now it hit TP, but what could happen is that after we got a break of structure above this high, we could then again get our pullback and then trade up higher again, where we could have taken a stop loss. So how could we refine our trade so it becomes a 1 to 3 even when we trade like this? Well, how do we do this, we go on the lower time frame and we take a look at liquidity inside our demand zone that we want to go long from. So let's go to the 1 hour and let's show you how this works. So we got that 4 hour fractal break over here, and after this break over here we then wanted to go long. So at this moment in time we break this high, then what do we see? Well, that we have little bumps in the road which acts as liquidity. So this is another liquidity point. As you can see, we first take internal liquidity inside this demand zone before we move up higher. So what could also be an entry? Well, on top of that liquidity, of course, a stop loss safe under the low, and then if we trade for a 1 to 3, you see that we would have hit RTP before we got the break of structure. So this is a lot of safer of an entry to trade up higher. Otherwise RTP, as you just saw, would have been all the way over here. So this is a perfect example of how we use liquidity in our entry model to use a refined trade. So I hope this was valid. I hope you learned a lot. If there is anything unclear about liquidity, make sure to comment down below, and see you guys in the next educational video. Bye.